Hello everyone, welcome to Global Economy and Foreign Exchange Market Outlook for the first half of 2023. I'm Hyun from Shinhan Bank Solution and Training Center. Thanks for joining us today. Well, looking back, the year 2022 hasn't been easy because of the unexpected outbreak of the Russia-Ukraine war, followed by stagflation and the Fed's aggressive rate hikes. And such issues are still unresolved. Well, today, we'll briefly review those issues and go over some key viewpoints for next year. Then we'll finish up with forecast of major and emerging market currencies in the first half. In 2023, the global economy will grow at 2% rate due to the aftermath of rapid tapering measures. Next year, pressure on price inflation and rate hike will be mitigated as the Fed and the BOK are expected to lower rates in the fourth quarter. But considering the fact that globally debt has increased after the pandemic and the Fed has raised rate too high to the point where the economy can't tolerate, the economy won't recover easily. It's uncertain whether the global financial crisis will be repeated, but credit risk will be prevalent, and the US and the Eurozone is expected to experience nearly 0% growth, while Korea is expected to grow at about 1% rate. The present market is driven by complicated circumstances that the market has never experienced in few decades. In that sense, we'd like to look back on three distinctive economic epochs in the US economy and compare them to the current situation to get an insight on the year's market outlook. The US economy experienced the great inflation in 1970s and 80s, where hyperinflation triggered by the oil shock and the progressive rate hikes of the Fed dominated the market. Then came the Great Moderation period, starting from 1990s to the financial crisis. This period can be summed up as a multi-decade period of low inflation and positive economic growth. But the financial crisis in 2008, triggered by the collapse of the real estate bubble, resulted in Great Recession. Recently, the economy also went through quite a struggle from COVID-19 restrictions and lockdowns. First of all, 2022 was pretty similar to the Great Inflation period in that high inflation level caused central banks to execute rapid monetary tightening. Yet while high oil price led the inflation back then, various supply and demand factors are intertwined now, and downward stabilization of price will be carried out very slowly. The inflation will near the Fed's target level in the second half of 2023 at the earliest. Although the Fed is expected to cut rates eventually, considering the fact that historically, economic downturn followed 70% of the times after the Fed's rate hikes, the global economy is exposed to recession risk. After the extreme hyperinflation came the Great Moderation phase, where the US experienced unprecedentedly long economic stability as the asset market grew along with the launch of the Eurozone and China's rapid growth. But today, advantages of the Great Moderation are fading. As each economy is obsessed with employment to meet political goals, global supply chain and division of labor have shattered, resulting in nationalism. Well, especially due to technological competition between the G2 and formation of blocs, geopolitical risk in areas such as Ukraine and Asia will have considerable impact on the economy and the financial market. During the Great Recession, low prices and extremely low interest rate added up asset market bubble, and private sector debt increased and caused deleveraging risk. Such circumstance is very similar to these days in that zero interest rate and large-scale debt monetizations were put in place to make up for COVID lockdowns, which increased debt considerably. Well, in fact, risk signals have already been detected as asset prices drop and loan repayment pressure increases due to inflation and steep rate hike. We should be cautious on real estate market slowdown and liquidity issues for quite a while. Considering three great phases in the past, 2023 won't be freed from recession and financial crisis worries. Of course, global monetary volume has increased and freely fluctuating rate is in place, allowing the market with more buffer than during the financial crisis in the past. And due to polarization of nations, industries, and households, financial crisis would occur mostly in surrounding areas. Also, next year, inflation pressure will be eased and central banks will shift their policies towards cutting interest rates. So we can expect that this time, we may avoid serious financial crisis like in 2008. But since emerging countries are relatively vulnerable and anxiety has begun to set in real estate markets, we still need to take subtle approach. Now we're going to look at key implications on the foreign exchange market. First and foremost is the Fed's tapering risk. Although the Fed has put controlling inflation first on its agenda and maintains tightening stance, as time goes by, it'll try to alter its stance in balance with the economy and financial market stability. It's possible for the Fed to raise rates to 5% in the first quarter, but the rate will be frozen as it checks inflation peak. Then in the fourth quarter, the Fed might cut rates in response to sluggish employment. So the rising trend of the US market rate and the dollar will be calmed down due to expectations on the Fed's pivot, meaning gradual change in its policy. Next, we're going to look at the global recession risk. As long as the global economy is exposed to deleveraging pressure and credit risk, recession worries will remain. Of course, it's a relief that China's economic indices may rebound first due to the end of the zero-COVID policy. But even so, it won't be a V-shaped rebound, but rather a slow growth. And the US and the Eurozone will be exposed to downward risk up to mid-2023. Next is the global credit risk. Even if the monetary policy changes, high interest rate will remain for quite a while. And foreign exchange rate fluctuation will increase during the period where debt burden is accompanied by recession worries. Yet considering abundant global monetary volume, the current situation is different from the past. Also, since the policy is gradually shifting towards monetary easing, we believe that the risk will not be detrimental. The next one is global geopolitical risk. As global cooperation crumbled, competition and confrontation between the two sides centered on the US and China is unavoidable. Also, interests of the US, Europe, Russia, and China are intertwined, complicating political and geological environment. In the upcoming year, although we may expect the Ukraine crisis to calm down due to Xi Jinping's third term and power shift in the US Congress, the G2 may confront each other in various economic fields, including trade, technology, energy, finance, and security. Lastly, let's talk about capital outflow risk. Although it's hard to predict given that monetary policy, economic cycle, and credit risk are complexly reflected, we can at least predict the general flow. Considering economic circulation and inflation flow to come, in the first half, as economic downturn and inflation slow down, the economy will move towards reflation from stagflation. Amid inflation reaching the central bank's target level in the second half, global economic slump will slow down and the economy will enter recovery phase. Now let's talk about next year's outlook for major and emerging market currencies. Because of credit risk, demand for safe assets may maintain dollar ascendancy. But there's a consensus that dollar has been overbought in the global foreign exchange market. So if reverse opportunity comes, the dollar may fall rapidly. Although the dollar is considered to be reaching its peak, the path of the dollar may be flexible depending on the end time of the Fed's tapering measures, energy crisis in Europe, China's real estate market crisis, and geopolitical risk. Expected range of the dollar index is from 100 to 114. The shift in dollar movement will also affect the euro, but the development of the Ukraine war is a variable. Even if the situation goes optimistic, due to the difference between monetary policies of the Fed and the ECB, the rise of the euro will be limited. Also, amid global economic downturn, due to emergence of credit risk within Europe, we should also be cautious on reoccurrence of financial crisis. Euro to dollar rate is forecast to be at the level of 0.96 to 1.12. Tremendous volatility will be caused if the BOJ decides to withdraw its yield curve control policy or even to shift the level upward. If the BOJ's dovish stance changes, dollar to yen rate may spike and then change the course. But the BOJ may try to hold out until the end of the Governor Kuroda's term in April 2023. Other than short-term volatility that the BOJ may cause, if the US 10-year Treasury yield falls, Japanese yen would strengthen. Dollar to yen rate is forecast to be at the level of 125 to 150. Attractiveness of China as an investment market has weakened and the momentum has also slowed down. The tension regarding Taiwan also adds burden to the market. Amid continued real estate market crisis, weakening of the yuan will continue for a while due to worsening conflict with the US and differentiated monetary policies. If the exchange rate is to rise in the first half and fall in the second half due to weakened strong dollar momentum, mitigated global inflation, and China's zero-COVID policy. Dollar to yuan rate is forecast to be at the level of 6.85 to 7.30. In the first half, dollar to rupee rate will receive upward pressure but attempt to stabilize downward once the Fed slows down the rate hike. Especially inducements such as supply chain rearrangement triggered by the G2 conflict and relaxation of regulations will encourage foreign capital inflow, enabling downward stabilization of the rupee rate. The rate will gradually drop starting from quarterly average of 82.5 in the first quarter to average of 80.3 in the fourth quarter. Yearly, dollar to rupee rate is expected to be around 81.5 level on average. In the first half, because of external factors including global recession worries and increasing political uncertainty, the rate could receive upward pressure. But towards the second half, it'll stabilize downward as the Fed's slowdown of tightening measures and decrease in inflation worries cool down the dollar ascendancy. But risk factors such as global economic slowdown, decrease in trade volume, reinforcement of regulations, real estate market risk due to high interest rate may trigger rise in rate. The rate will gradually drop starting from quarterly average of 24,800 in the first quarter to quarterly average of 24,300 in the fourth quarter. Yearly, dollar to dong rate is expected to be around 24,590 on average. In 2023, dollar to won rate is expected to move in the range of 1,230 to 1,430. In the first half, amid global economic downturn because of geopolitical uncertainties including domestic and overseas credit risk and conflict between the G2, dollar to won rate would attempt to rebound periodically. Yet as time goes by, due to the Fed's pivot and expectations on slowdown of global economic slump, the rate will stabilize in mid to long term. In conclusion, dollar to won rate may face some resistance and downward rigidity in the first half, but as nearing the year end, stable downturn would follow. Well, that'll be all for today. It's been my pleasure to provide you with Shinhan Bank's global economy and foreign exchange market outlook for the first half of 2023. I'm your host, Hyun, and should you have any questions, feel free to contact us at Solution and Trading Center. Thanks for watching.